This is the current federal tax developments for the week of September the 22nd, 2025. Current federal tax developments are brought to you by your state society of CPAs. This week, from here in Phoenix, I want to talk to you about a few developments that have been coming up. First, we did have the publication of final regulations for catch-up contributions. Remember the mandatory sending of catch-up contributions in 401k and similar plans to designated Roth accounts for individuals above an income level of $145,000, adjusted for inflation. We do have the final regs on that. We also know the first year you got to do it now officially. We also got this week the draft Schedule 1A, the thing we had been told was coming indirectly by the instructions to employees on the 2026 draft W-2. We're going to look at the 2025 version of the draft Schedule 1A. And in case you were still thinking, somehow, that I'd been totally wrong about the fact that, these are all above the line deductions because I saw it written here, 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 and here. Schedule 1A and the draft 1040 that was modified to go with it both make it very clear. These are not deductions used in computing adjusted gross income. Makes it very simple. Third, we had a number, and it's continued beyond the ones I had at the time I wrote this up. A number of state revenue departments have posted notices in the past week regarding phishing and smishing scams related to state revenue departments. So be ready. Even if your state has not published one yet, it appears that the scammers are definitely going after state revenue departments. And it doesn't necessarily have to be an income tax related revenue department because we had Texas publish a warning for franchise tax board, for not franchise tax, but that's California, but for the franchise tax. There are some scams that have been run around there. They're going to find new things. I'm going to talk about the Blomquist Holdings case in the tax court, how it related to what is essentially TEFRA partnerships. And, whether somebody can come in and object late in the process. And the court said, yes, but it's not an absolute right for you to try to insert yourself into the partnership proceeding at the last second. You hadn't done so earlier, so we're going to find out that when certain partners were not happy with the agreement that was being arrived at by the tax matters partner, remember that back in the day? Yeah, instead of the taxpayer representative, right, tax matters partner, the partnership representative, this old tax matters partner, this is a TEFRA case. They tried to come in late and raise their objections. The court's going to say, yeah, while that's allowed, you have a really high hurdle to clear. We have two bills that cleared the House Ways and Means Committee by unanimous votes, I guess. There were some cases where not everybody was present or not everybody voted, but nobody voted no on these two bills. So at least on paper, they look like they have a good chance to make it through Congress, assuming anything moves through Congress at this point. And so we'll talk about what's in those bills. They're really tax administration issues, but we'll talk a little bit about them. And finally, we did get proposed regulations on the qualified tips deduction. This is the place where they officially gave us the list of occupations that normally receive tips. But they're also going to explain some of the reasons why, even if you receive tips in an occupation listed on that list, and your income's low enough, you still might not be able to claim the deduction. We'll talk about the interaction of the specialized service trader business rules and how that could impact an employee of a specialized service trader business who is in an occupation that otherwise could have qualified for this. Plus, the weird way it may limit self-employed individuals who, if they were an employee, of the organization, if there's a question where they are or aren't, would get qualified tips. But the fact they're self-employed, they won't. So we'll talk a little bit about that. Well, let's talk about the final regulations on the Roth catch-up contributions. Under the Secure 2.0 Act, this is Treasury Decision 10033. The proposed regs were published in the Federal Register on September the 16th. Now, these are the final regulations here. So there were statutory changes to catch-up contributions made by the Secure 2.0 Act of 2022. And under that act, remember that individuals with income above, your employees with income above $145,000 had to make their deferrals, if they're going to do a catch-up, that had to go to a designated Roth account. Now, it's been delayed for 2 years. So bottom line, right, we haven't had to do it, even though we should have been doing it in 24 and 25. But these are now the final regs. So we'll talk about that. We'll also talk about a weird way that year 26 will be treated. So we'll talk a little bit about that. But this is, as noted, the mandatory Roth catch-ups. They were supposed to take effect in 24. Again, we had the IRS delayed them by Notice 2023-62 for 2 years. What's happening now is we have these rules, the regs in detail. Now, these are the final regs. These final regulations interpret the law. According to the IRS, these final regulations, because the IRS position will be, as always, that they will clear the Loper-Bright test, that you have to follow these regulations. You have no choice, even if there are other ways of interpreting the law, for plan years beginning after December 31st, 2026. However, you can go ahead and early apply these provisions if you wish to. Now, the problem is that the administrative transition period, which said, don't worry about that, don't have to do this whole Roth IRA deferral routine, that is still going to end at the end of this year. So what that means, and it's tough because people have trouble putting this together. For the plan year that begins in 26, let's assume you have just one. I realize you might have multiples and there's all kinds of, but let's not deal with those cases. You have those cases, you can figure that one out. But for a plan year beginning in 26, which for most of us will be the 26 calendar year, we can use these regs if you want, but you don't have to. And the reason they most likely did this was because a number of plans have probably been setting up, realizing that that administrative relief only applies for 2 years. It's going to end at the end of 25, and the IRS has said nothing about extending it. So because of that, it's like, we got to get ready. It looks like we have to do this, even if there aren't final regs out yet. So what the IRS has said, if you want to, and I suspect it'll be a plan where they've already, done work, outlined the work, and put things together, put systems together to make this work for their 26 plan year, as long as you have a reasonable good faith interpretation of the law, which does not have to agree with the final regulations, you can use that for 26. But in 27, your first plan year beginning after December 31st of 26, you're going to have to go to the final regs. So that puts you in a case of having to decide, is it worth it to go ahead, junk what we've already done, and program our systems to comply with the final regs? Now, the advantage of doing that is that if you comply with the final regs, then you're not going to have to explain to people why 26 is one set of rules, but 27 is a different set, to the extent there's differences. Of course, the downside is you've done all that work and you're getting nothing for it. If you've not yet begun implementing anything and haven't even really thought about it, then I think it's probably a virtual no-brainer unless there's some very specific facts which begin to get me worried about the IRS agreeing this was a good faith interpretation. But unless you had very specific facts, I don't know why, you would end up wanting to have the mess of saying, well, for this year in 26, the plan works this way, but in this year, 27, it works a different way. So we'll just kind of leave it at that for you to decide as to how you want to deal with this. But again, reasonable good faith interpretation standard applies because in publishing the regs, IRS made clear the administrative transition period under Notice 2023-62 will not be extended. So you do not have the option of saying, yeah, I know your W-2 last year showed FICA wages of well over $145,000 adjusted for inflation. But you can go ahead and you make your catch-up contribution for 26, and we'll let you go ahead and put it in the non-Roth account, so you get the tax deduction. You can't do that. There is no way I see allowing you to put it into a non-Roth account is a good faith interpretation for somebody who is clearly over the limit. The one example they give in the regs about that sort of good faith interpretation they'd allow this year, there was kind of a debate and concern, should you be using FICA wages? Or really, didn't they really mean Medicare wages? And should Medicare wages be the measuring issue? the IRS has said, essentially, in the final regs, we are going to use FICA wages. So that has to be what your plan uses for every year after 2026. However, here's the big however. You don't have to use, in essence, using Medicare wages for 26 is deemed to be a reasonable good faith interpretation of the laws that existed, even though the regulations will not allow its use. So that's our one example of what works in that area. Now let's talk about the threshold. Remember, Roth IRA. So this is something that's now happening in our retirement plans, in our plans with deferrals, 401ks. Participants whose prior year FICA wages from the employer exceed $145,000, adjusted for inflation, must make catch-up contributions to the plan as designated Roth contributions. In essence, bottom line, there will be no deduction allowed for that 401k deferral once we get to the catch-up amount that's effective next year. That wage threshold is going to be based on Social Security wages, Box 3 of Form W-2, not the Medicare wages. This is a key clarification from the proposed regulations. That's part of the reason why they are making it very clear that if you want to use Medicare wages for next year, for 26, we're okay. If you're already set on that, you told everybody that's what you're using. It generally won't really make a difference, but there are some odd cases of employers who, are not subject to FICA, but the employee is subject to Medicare, so you have Medicare wages, not FICA wages. So anyway, they said, so they're saying use difference, but they're not going to ding you just because your plan or you told the employees you're using Medicare wages this year, as long as you do it. Now, for aggregation of employers, generally every employer stands alone. If your employee worked, let's say, half the year for one employer, half the year for another, their total wages were in excess of $145,000, but their wages with you in the prior year were only $70,000, then they're not covered by this for the following year. However, if you have related employers, there are, issues that can be involved here. Plans may elect to aggregate wages for control group or common paymasters. So if you want to, just for simplicity, you can say, yeah, we're going to aggregate. Maybe you pay somebody half the wages gets paid out of one, half on another. You got common paymaster rules. So they're getting paid out of two different employers. And that's a very realistic scenario where you might want to do this. Just say, because you have to explain to the guy who only gets paid by one of the companies why he can't get a deduction, but this other guy that's getting paid by two companies does get a deduction. It's like, wait, huh? Wait, because I only work for this division, and this guy splits his time between two divisions. He gets to get a deduction, but I don't. Yeah, that could be tough to explain. So you can elect to aggregate. Now, if you permit Roth catch-up contributions for high earners, and utterly not surprised by this, I think it was what Congress meant to happen. Some people wanted to say, well, can I just basically say those are the only ones that can do designated Roth? I don't want to deal with that. Sorry, no. If you offer an option to use designated Roth to your high earners, so they can make their catch-up, you have to allow non-high earners to make designated Roth catch-up contributions as well. Everybody must have that option. Now, it apparently can be limited to catch-up. You don't have to allow the regular contribution to be a Roth, designated Roth, but you have to allow catch-ups to be done that way. So it has to be done that way. A plan without a Roth feature. So let's say your plan does not currently allow Roth. The regulations make clear that it's not going to cause your plan to fail if you don't allow catch-up contributions for those who would have to have it going to a designated Roth account. And I'm sure the idea of this was to Congress, so that's kind of reverse discrimination. It's the high earners who are going to be told they can't do it. That probably means the company is basically, it has their plan. It allows catch-up for the rank and file, but it doesn't want to deal with this mess for the owners and have to do this Roth accounting. That's okay. You can exclude, tell everybody who makes $145,000 adjust for inflation that I'm sorry, you cannot make a catch-up contribution. You don't have to do it that way, but you're allowed to do it that way. You can say that that's okay. You don't have to, basically remove that feature from the plan for a catch-up contribution that goes into the non-designated account for those who aren't required to use it as a Roth account. Again, that's a plan design choice. And, I think their theory is that probably the high earners have enough influence to argue for themselves if they really wanted it. So, yeah, they're going to let it go. Now, there is also the concept of, can your plan have a deemed Roth election? For administrative ease, a plan can provide that a high earner is deemed to have irrevocably designated any catch-up contributions as Roth, provided that you give the participant an effective opportunity to make a different election. So rather than having to go back and say, sorry, I got to toss out your catch-up, basically your catch-up contribution election, and you need to give me a brand new one that says you want it as Roth, I can just have the plan say that once you go over this limit, you have made an irrevocably designated the catch-up contributions you made as Roth. As long as they have a right, you're going to notify them their money is going into Roth, and they have a right to change their election, essentially to opt out. That is election. Now, if you're going to do this, though, that deemed election must be in the plan document. You can't just administratively do this and say, hey, I don't want to deal with this. I just, I don't want to bother the plan. My plan's through a third-party administrator, and they're going to charge me to add this. So I'm just going to do it. No, I'm just going to do it doesn't work. That's not how this happens. There also are some corrections there if you have a failure when the plan doesn't follow through and do this as they should. To use these correction methods, you must have procedures in place, including a deemed Roth election provision. And why that's important is, if somebody deferred to their 401k account and they wanted, and you told them it'd be tax-free, and you never told them if they went over the income limit, it's going to become Roth because you just didn't have that in your plan, you can't use corrected, because the only way to correct is to go back and re-push it into Roth in some form. And if you do that, then yeah, they're saying, no. You can't force somebody into Roth. They have to understand that you have to tell them if it's going to be Roth, they have to at least have the choice not to go there. And yeah, if you don't have that designated Roth provision in your plan and you warned them ahead of time it could go there, then you're not allowed to use these. Now, there are two methods here. The Form W-2 correction method, which is only available to W-2 for the year of deferral, has not yet been furnished to the employee, is to transfer the contributions plus earnings to a Roth account and report the original contribution amount on the Form W-2. It's only available to W-2 for the year of deferral, has not yet been furnished to the employee. Once the W-2s are out, your only option is, on the correction method, is an in-plan Roth rollover. You take the amount of the Roth deferral plus earnings. That's the big difference here, right? Now the earnings have to go over too. You got to figure out how much earnings they've had. Has to be treated as rolled over to a Roth account and is includable in the participant's income in the year of the rollover. So let's say they should have gone to a Roth account in 2026. But, failure occurred. Nobody noticed the issue. Nobody caught it. If you catch the problem before the W-2 is handed to the employee, so basically early January, you can just put it on that W-2, assuming that you had the deemed Roth election provision in your plan. However, if you don't catch it until March or April, let's say because, and I can see this one happening, basically the tax preparer for the individual takes a look at that W-2, knows they worked for the same employer the prior year, knows their income in the prior year was above the limit, and asks, well, this is an improper deferral if it's all going into your regular 401k. Are you sure this W-2 is right? And they go back and, well, the W-2 is right. I mean, if the W-2 is in error, you could fix the W-2. If it really had gone to the Roth account internally, fine. But it hadn't. is staying in the regular account. Now what you have to do is, nope, don't worry about that W-2 for 26. That's not going to be changed. However, in 27, there's going to be a deemed rollover, an in-plan rollover, not just of what they deferred, their catch-up contribution for 26, but also our calculation of earnings on the catch-up contribution. I'd pay tax on that as well. That'll be treated as rolled over in 27 when we caught the problem. So those are your methods. The regulations also tell us about the enhanced catch-up limits, which are proposed 2024. Remember, for those people aged 60-63, the limit increases to 150% of the standard catch-up limit. Again, $11,250 for a non-simple plan. And it says that essentially a plan does not fail universal availability by offering this higher limit to the 60-63 age group. Right? It said, they just cleaned that up in the regs, because otherwise it's like, well, I can't do it. It's like, yeah, we're going to go ahead and say you could do it. Now, again, that enhanced catch-up, right, if they're over 145,000, is going to go into that designated Roth account, so keep that in mind. Now, key exclusions. The Roth catch-up requirement does not apply to a SEP IRA or a simple IRA. Remember, SEPs don't really have, I should say SAR-SEP. Not SEP IRA, SAR-SEP. Remember, SAR-SEPs are the only type of SEP account that had a deferral provision. But these Roth catch-up requirements don't apply if you have an old SAR-SEP or if you have a simple IRA account. A simple 401k it will apply to, but a simple IRA it won't. And the special 403b catch-up contributions for employees 15 plus years of service are not subject to the Roth requirement. That's also made clear. Now, the deadline for correcting statutory limit failures is the last day of the tax year following your deferral. Notice deadlines for earlier issues like the 402G excess still applies. And correction is not required if there's de minimis failure of $250 or less. They're going to let you in with that. Okay. Next up, we already talked to you about this. We talked about the W-2 draft for 2026 because this is a key bit of information we had. Now the IRS has published on their website, go to the draft form sections, and you will find a draft Schedule 1A, Form 1040 for 2025, the draft of that form, published on September the 14th. Now, again, it's an early release draft. It's not going to be filed. It could change. I don't think it'll change much, but it does introduce many new deductions for this year that are part of the One Big Beautiful Bill Act. The big thing to remember is, and notice, because there was so much bad press, so many bad articles out there that claimed these were above-the-line deductions and would reduce your AGI. Schedule 1A, along with Schedule 1040, the draft 1040. Schedule 1A will tell you to carry the total numbers it computes on that form to line 13B. Line 13B is after the calculation of adjusted gross income. In fact, what 13A is the QBI deduction. I guess they still felt that you could just own lines that had it before and people get confused. And 13B is everything else. It will not reduce AGI. That means you cannot reduce AGI for, let's say, premium tax credit purposes, nor do you reduce AGI for purposes of IRMA calculations for those on Medicare. If you qualify for any of these deductions, which, we'll talk about the things on here. Right? This total on Form 1040, on Schedule 1A, forms to that line 13B, a brand new line. And most deductions on this form, the first thing on this form in Part 1 is a computation of modified adjusted gross income, because every one of these uses the same MAGI calculation. As we all know, MAGI varies. Different provisions in the law have different modifieds. All modified tells you is it's not pure vanilla AGI, but you still have to go find out what modifications are needed for this provision. But all of these use the same modifications. We take adjusted gross income, we add to them the foreign earned income exclusion, we add the foreign housing exclusion, and we add the territorial income exclusion. So those are the three. That computation is in Schedule 1. That gives you the modified AGI, right? So that's there. Now, qualified tips are in Part 2. Smaller of qualified tips are $25,000. The phase-out begins for modified AGI at $150,000, $300,000 for married filing joint. and reduces $100 for every $1,000 of modified adjusted gross over the threshold. Now, that $25,000, it doesn't matter if you're single or married. That's the most can be on the return. What if both spouses work in tipped occupations? Sorry, you have one $25,000 pool to work from. I thought Congress hated marriage penalties. Talk to your congressperson. Why in the world did they put a brand new one in the law? You got to ask the Congress. You got to ask Congress, got to ask the staff. My guess is, like a lot of these, the staff doesn't really understand the concept very well. And so they just left it like that, because what's really funny is the qualified overtime deduction does not have a marriage penalty, right? That deduction is a smaller qualified overtime compensation, or $12,500, $25,000 if married filing joint. The phase outs begin at the same level on the same method. So $100 for every $1,000 of modified adjusted gross income over the threshold amount. So same basic structure, but this time without a marriage penalty. Qualified car loan interest deduction. Again, hey, we get a marriage penalty again. It's a smaller or qualified passenger vehicle loan interest, or $10,000. Right? The phase out begins at $100,000, $200,000 for married filing joint. And this time the reduction is $200 for every $1,000 over the threshold. Right? The modified excess AGI is divided by 1,000, increased to the next higher whole number. That's also a mechanical definition. So it's quirky. Finally, in Part 5 is the enhanced deduction for seniors, $6,000 per qualifying individuals. Those are born before January 2nd, 1961 for the 25 return. The phase out begins at modified adjusted gross income of $75,000, $50,000 for married filing joint. And the $6,000 deduction is reduced by 6% of the modified AGI exceeding the threshold. And why is that $6,000 deduction? If you're a married couple and they both are over the age of 65 or over, I have a $12,000 deduction, but it's going to phase out just as quickly over $100,000 as if only one of us was over age 65. That's also a quirky, and no, I can't fully explain the reason for it, but it's quirky and it's how it works. So just accept that here. So again, this new Schedule 1A will be part of your 1040s for next year. So if you were hanging on to hope, saying, I don't know who this guy is who keeps telling me that it's going to be not reduced AGI, and you're holding on believing that I'm going to go ahead and buy that article I had, or that CPE course I took the day it passed, and saying, yeah, it will. No. Go look at the form. It doesn't. And as I've told you, I've gone through that analysis before. It never was going to, right? If you follow the law, this is how it works. And the law is not ambiguous. The law is very clear. So this is how it works. Next up, it appears scammers have gotten tired of telling you didn't pay tolls, on a highway, and are now moving on to state revenue departments and sending out scams in their name. By the way, the car toll one was hilarious in Arizona, because they told us the Arizona Department of Transportation was going to, of course, do all kinds of nasty things to us unless we paid these overdue tolls. And why that was hilarious in Arizona is because Arizona has no toll roads. So it's like, no. It doesn't work. But the scammers didn't worry much. They just made minor modifications. So we have had a whole series of state revenue agency alerts come out. Now, I wrote this early in the week. Then we got some additional ones later, but we'll kind of leave that as it is. So in mid-September, we had a number of state revenue departments, and as the time I wrote this, I had found them in Virginia, Texas, Minnesota, New Jersey, North Dakota, and Michigan, had issued urgent warnings against phishing and smishing text message scams. In addition, just straight up phone calls. So you'll see that the scammers are impersonating these revenue agencies via text messages. Text became the big thing, I think, that happened right around the middle of this month. But they also could do it via email or phone calls. They're going to specifically come after personal information and financial information, like your bank accounts, right? Ways to get and take stuff. Now, the one common theme with the ones we're seeing now is a fraudulent message claim a tax refund is pending or will be voided and require you to click a link to provide banking or personal details, which will then be used to make sure your bank account shows a nice zero balance next day. So it would be a good idea to click those. You got to assume these scams are going to target every state. You need to advise your clients that this is happening. And even if they haven't come yet, I've not heard one reported yet for Arizona. That doesn't mean they aren't coming. Arizona will probably see them, as will other states. By the way, California Franchise Tax Board had actually put up notices about this, I think, back in August. They may have targeted California early, but we've had lots that gone under. So what's very consistent, these agencies across states, the state tax agency will never initiate contact via text message to ask for sensitive personal financial information. A few of the states have a system set up where they would notify you when your refund is approved, deposit your bank account. Yeah, a few of them have those things, which is why I think they got this idea, because obviously that like it or not, that convenience option sets up the scam. Unfortunately, convenience and, scammers look at that and say, hey, these people are waiting on their refund. And let's say, the whatever Department of Revenue has a system where they'll text you and tell you your refund's been issued. So why don't we just text people and tell them their refund's being held up? And they're going to lose it entirely unless they respond immediately and give all the banking information. Yeah, you got to watch that. Always, always, always presume a text message is a scam. And by the way, when I say text message, I include messages that come via iMessage, right? Messages that come via RCS on Android. I include messages that come via things like WhatsApp, right? And, other things, Signal, etc. Just assume they're scams. That's the safest. Generally, even for those states that tell you refunds coming, they will never demand payment or personal information via a text message. They will normally contact you via U.S. mail. That's how they're going to, come forward and do this. They're going to do it by mail. Almost always, if they're doing something serious, it's not going to be by a text message, or it's not going to be by a threatening phone call, followed by telling you that there is a police officer coming to your house to arrest you unless you give them this information, to take the money out of your bank account right now. Yeah. By the way, in some cases, they also have the supposed cop call after, you hang up with the Revenue Department to make sure you're doing it. So it's like, yeah, there are some really involved scams. So number one rule to clients, and this is not just for this type of scam, this goes anything from their bank, their broker, etc. Do not click on links in suspicious messages. I'll tell you that suspicious messages are any message that you were not expecting to receive. If it's telling you to click on a link to do something, generally I'd say don't do that. Just go to the website of the organization, or better yet, call them via a phone number you get from the agency. If you truly owe the department money and you talk to the collections department, they're going to be able to tell you, yeah, you owe us money. Okay? I don't like clicking links in anything unless I have a super high level of trust, in that. Never reply or interact with the sender in any way, shape, or form. Right? That's only going to prove you got a live text number. Right? Hopefully they are getting better at picking out scams, but the scammers are pretty good about getting around the scam blocking that may take effect. And it's also a reason why, I'm pretty sure it's a reason why they've used things like iMessages to send out, because that stays encrypted until it gets to the user. It's going to be very difficult for that to be scanned by anybody coming to you. That means that if any scam detection is going to take place, it would have to take place on your device. And yeah, that may prove difficult, because it's much easier to get the information about the scams going on if you're looking at, millions of these texts go out and they come through your system and you see them. That tells you this looks like a scam. And you can probably stop them fairly quickly. But if it goes through a protected iMessage or RCS, on Android, that is, that's actually the secure kind, not the IRS RCS, which is still missing, although supposedly coming soon, but still missing any form of end-to-end device encryption. So it's just going to send it in plain text. You're communicating to or from a Apple device and assume, therefore, it's going to go in the open. When they finally fix that, it'll be great, but they haven't turned it on yet, so keep it straight. But go with that. But why they would do an encrypted RCS, and that may be a good thing to look at on this, an encrypted RCS, or use iMessage format, so you'll say their iMessage in your Apple messages, is because, it's going to be tougher to get. And in case you haven't been following, I'll just kind of leave this. You've been aware that there was a bit of a fiasco last year with Apple and Apple Intelligence not really working as well as they had said, and they never had really promised scam text screening. They claim they're going to try to do something this year, so we'll see if they can. But it requires a really good on-device screening. And I will tell you that essentially, at least for SMS-style text, certainly I get much better screening. I have both an Android phone. I have multiple lines. So I have an Android phone. I also have an iPhone. And a whole lot more scams get through on the iPhone. So I just kind of know it's likely to fall through there. So keep that in mind. Make sure you delete the message and block the number, although they are highly unlikely to ever reuse that number. So that's, do it. Might as well. It can't hurt, but also probably going to do a darn thing. Again, if your client's just nervous, they're scared, they're going to show up and arrest me, call the agency directly using official phone numbers on the agency's official website. Call them. Look for collections. Call them. If they are truly sending the cops to arrest you, which, by the way, they aren't, but if they truly were, they'd know about that. By the way, the same thing's true about your credit card company. If there are supposedly fraudulent charges on your credit card, they'll know about it too. Okay. And you can consider to, report the scam to the appropriate agency. Like, for instance, the Texas revenue people, have a website, have a address of stop.spoofing at cpa.texas.gov, an account that you could then send an email to report your scammed, the scam you got. And a copy of that scam text can be useful to at least let the people, if you've caught scam texts coming from anybody, it can be useful to let the party that's being impersonated know about it so they can get the warning out there. Because, yes, I expect almost everybody is going to have these scams done against them. Next up, we're going to have a late TEFRA settlement objection. This is a public tax court decision. TEFRA stuff's still out there, so there still could be some cases where it's going to matter. This is Blomquist Holdings, LLC versus Commissioner 165 TC number 6, issued on September 17th of 2025. Now, this case involved a TEFRA partnership that claimed a large conservation easement deduction, which the IRS had disallowed. Now, obviously, the tax matters partner and the IRS gets into discussions, and they negotiate finally a settlement with the IRS, which includes allowing $11.7 million deduction, which is actually kind of nice. They would allow it. They would even say that it would be allowed as a deduction and not treated as a 2% itemized deduction, which means you'd get it. It'd still be itemized. It wouldn't be that. That's an interesting settlement, but they did it. They said they'd get that deduction. So you'd be able to take it that way. And they reduced the penalty because, again, this is that, understatement or overstatement of value because they're settling it, right? This is being settled at the appeals level, or basically at the appeals or at the trial court level, not trial court, but, with the chief counsel's office. Because it's a settlement, they can drop the penalty from 40% to 10% in order to get the settlement. And again, the IRS is allowed to do that in a settlement because they can consider the risks of litigation. An agent can't do that because there is nothing under the law that imposes a 10% penalty for doing this. The penalty imposed is 40% and literally can't be waived. So you either be 40% because it applies or nothing because it doesn't. But it couldn't be 10. But they can do that. And $11.7 million, deduction related to, related to this investment, that would be considered a 212 expense, you'd think, and would have to be subject to 2% because it's not a trade or business. They could just kind of allow that. Again, it's a settlement. So after settlement was reached, 39 non-participating partners wanted to object because they had disallowed I think it was like a $50 million plus deduction. So that, they're going to get a deduction of 11.7, and they're going to pay a much smaller penalty. Okay. But 39 partners said, no, we want to participate. And as far as we're concerned, if that's as good as the IRS will allow, we're not going to settle it at there. We want to go to trial. But here, the tax court denied their motion. Now, they had claimed they had a statutory right to participate. And the court said, you do have a statutory rule that allows you to, apply to participate. But that's not absolute. And it is subject to the tax court procedure rules per the statute itself. And you guys waiting to see what the deal is and then deciding to opt out is not what the law intended, right? The right to participate under 6226C is governed by the tax court rules of practice and procedure. To object to a settlement at the last minute, a non-participating partner must meet the substantial showing standard under tax court rule 248B4. Now, that is way higher, and intentionally way higher, than the sufficient cause needed to participate after the initial 90-day window, okay, allowed for you to file, okay? So you have 90 days to file, and you just need to show sufficient cause, and you'll be brought into the whole deal, negotiation, eventually litigation. The tax court held that objecting partners failed to meet this bar. Simply being ready to litigate, because that's what it said, we are ready to litigate this right now. Court said, that's not good enough. If you wanted to be able to move forward and litigate this, you should have jumped in during the 90-day window. Then we would have probably let you in. But you waited to see what kind of deal the tax matters partner could get. Now, they also said, the second reason was, the tax matters partner had a conflict of interest because they were involved in other things with the IRS. And the court said that was speculative. They said you really didn't show exactly, where was the improper conduct. And more importantly to the court, even if there was a conflict, you knew about that issue from early on, well before you filed this. You failed to act when everybody knew about the fact they had other similar structures under exam. If you were concerned about that conflict, you should have raised your objection right then. Because that was the conflict. The conflict is not the settlement. The conflict is that they basically might be biased and not fully push for, the rights you might otherwise push for because they might feel it could have a negative impact on their other cases. And they said, yeah, but you knew about this for a long time. You really needed to object earlier. What you waited to do, which is what we're not going to let you do, is see if I like the settlement or not. That's not, if you have concerns or you want to be able to object to the settlement, you should have jumped in much earlier. It would have been way more costly. It would have involved more work, but you lost your chance. You waited too long. So realistically, you want to elect to participate within a 90-day window. If you have a TEF or partnership, you're a partner who's in the group that is allowed to do it, that gets notice, a notice partner. You want to make sure if you want to participate, you do that within the 90 days and under Rule 245B, then you're probably going to get in without having to jump through big hurdles. Once you let that 90-day window go away, especially when you wait till settlement is reached, that's a high risk, very high risk strategy. They're not going to permit a late entry based on your mere desire for a better outcome. That's really what they wanted here. They didn't like it. So if you're considering doing this and you're in a TEF for a partnership exam, you need to be monitoring the tax matters partner and act promptly. If you find any reason, if suddenly it comes to your attention that the TMP has a conflict or they enter into bad conduct, then you must use motions of available tools like the motion to remove the TMP under 250B in a timely manner. If you delay, it's going to undermine your claim because, again, you knew about the problem, but you still figured if they got a good deal, I wasn't going to disturb it. You got to make your choice. If you're going to object to the problem, you have to do it timely, right? So what the decision reinforces is the old TEFRA rules were designed for efficiency and finality. They're meant to protect partners that actually engage in the process, but they're not meant to give you a second bite at the apple if it comes back and you don't like the deal that the TMP negotiated. Next up, new tax bills. Well, they're not going to be huge things, but they are there. And they're meant to resolve a couple of problems. And the fact that they both passed without any no votes tells you that these are not the most controversial provisions we've ever seen. It's House Resolution 5346, the Fair and Accountable IRS Reviews Act, that cleared the Ways and Means Committee on September 17th, and H.R. 5349, the Tax Code Improvement Act, that cleared them on September 17th. Again, same thing, cleared Ways and Means the same day. Now, the Fair and Accountable IRS Reviews Act. Let's talk about that one first. Right? It would amend Section 6751B regarding supervisory approval penalties. Remember, we've had that issue. The courts have ruled that the IRS, there's been a lot of dispute over whether, there's supposed to be supervisory reviews for penalties under 6751B. And the problem we've had is different circuits and the tax court have arrived at different rules. And so what's happening now, it depends. If your case would eventually go up to the Ninth Circuit, you're under one set of rules for when the court, for when the IRS has to have supervisory approval, versus if you're in, let's say, the Fourth Circuit, where you have another set of rules. Right? So, the rules are different everywhere. So Congress says, look, we're just going to step in and set up a straightforward, we're going to actually say the exact time when that supervised approval had to be received and exactly who the supervisor is that must approve it. Okay? So it would require the immediate supervisor to approve a penalty in writing before the first formal written communication proposing the penalty is sent to the taxpayer. So an agent could orally discuss an option for penalty, but the minute they're going to send a written notice to the taxpayer, right, that's going to propose the penalty in writing, they have to have supervisory approval before that proposal goes out, or the IRS is going to lose. Basically the court, it goes to trial, the tax court's definitely going to throw the penalty out, saying you didn't have it timely. Now, this is intended to basically resolve, I'll get that out, a circuit split on what constitutes timely, because there are various different times depending on where you're at. And they're saying, look, we need to define timely consistently across the country, so we now have. They're also going to define the immediate supervisor. Okay. It adds a statutory definition clarifying as the individual to whom the employee directly reports. That narrows a broader definition that was previously used by the administration in the past. And this will apply to notices issued and penalties assessed after December 1st, 2025, if it's enacted into law. Obviously, it's made its first step, but just the first step is what we have. The second bill to clear the Ways and Means Committee is the Tax Court Improvement Act. This bill, which also passed Ways and Means, has 4 key reforms to the tax court procedures. And again, there were 0 no votes on this clearing Ways and Means. First, they will expand the subpoena authority of the tax court under 7456A. It would allow judges to issue subpoenas for documents, ESI, etc., for discovery purposes, not just for production at a hearing or deposition. It would also expand the authority to use special trial judges under Section 7443 Cap A. With the consent of the parties, any case within the jurisdiction could be heard by a special trial judge, not, an appointed tax court judge. And they would be granted power to punish for contempt of court as well. They would be given that full power. They also would add a new judicial qualification standard, a new Section 7467. It would apply the recusal standard, where judges are supposed to excuse themselves from the case, found in Title 28 United States Code, Section 455, to tax court judges. So it would require recusal, get that word out, where impartiality might reasonably be questioned, is the standard they would now be required to go along with. The next one is big. We've discussed this one multiple times. We're now going to explicitly give the tax court the right to, basically consider equitable tolling on deficiency petitions under 6213A. Now, this is going to codify the decision in Batchelor PC versus Commissioner. That one only applied in a collection due process situation. Now, that was what the case is about. It's going to clarify that, yeah, we want that expanded to cover, a deficiency petition. So if you miss the 90-day ruling, then bottom line, if you miss the 90-day filing date, as long as you can show equitable, that you qualify under equitable tolling, which is still a high standard to meet, you could still file your petition. The court be allowed to hear it. It wouldn't lose jurisdiction on day 91, which is essentially the tax court position right now for deficiency petitions. I'll get that out right. It also adds a rule to toll the filing period for the number of days the tax court filing location is inaccessible, plus additional 14 days. So that clarifies something. Previously, if the due date had been closed on the due date, you got extra time to file. But what if it's closed for an extended period? Yeah, that wasn't clear by the law. They're clarifying that. Now, both bills have passed Ways and Means Committee unanimously. No, there are 0 no votes, but it's got to be scheduled for a vote on the House floor. And if it passes the House, it's still got to go over to the Senate. Most likely get a hearing in the Senate Finance Committee, and then get to the floor of the Senate, get 60 votes to allow a vote, and then, become law sent to become a bill sent to the president for the president's signature, which requires president's signature or a veto override. So, all of those things still have to happen. So none of this is law currently, but keep your eye on these bills. The fact that they pass with bipartisan support suggests they've got a reasonable chance of getting through, but we're again getting that time of year where things are getting a bit tough. And depending on how the government shutdown situation plays out, we may find that Congress is simply too busy for the rest of the year to consider these bills. Because you never know, because even if the Senate would go ahead and pass the bill that as it stands right now, the House has passed, and the Senate is refusing to take up because they can't get 60 votes to bring it to the floor. Even if they pass that, that would only move the deadline to just before Thanksgiving, which means we might still have the same problem. So, will Congress get to this bill before the end of the year? That's a real question. Finally, on Friday morning, we got a set of proposed regulations for the deduction for qualified tips. So this is proposed Treasury Regulation 1.224-1. This is in Regulation Project REG/110032-25, and it will be published in the Federal Register on September the 22nd, 2025. As you all remember, the One Big Beautiful Bill Act added Section 224 to the code, created a new temporary above-the-line deduction for qualified tips. Now, the purpose of these regulations is to define terms that are used in Section 224, and as was required of the IRS under the statute, publish a list of occupations that customarily and regularly receive tips on or before December 31st, 2024. Now, these rules would apply to tax years beginning after December 1st, 2024, so it would apply to the 25 returns. It is a temporary deduction, the regs point out, so it sunsets for any years beginning after December 31st, 2028. Right, so we're going to get that. The practitioners can advise your clients they can rely on these regulations for the 2025 tax years, provided they follow the rules consistently and in their entirety. You can't pick and choose. You can't cherry pick these, right? You can't cherry pick part of these. If you try to cherry pick them, you got to defend your position totally. If you decide to apply these rules in total, wherever they apply to your situation, you use them, then you'll be protected against an IRS challenge. Okay. So what's a qualified tip? They defined it. A cash tip received by an individual in an occupation on the official IRS list who's not excluded. Now, cash tips, that became a big issue, but the law itself is pretty clear about this. That includes checks, credit card, debit cards, electronic payments, and token exchangeable for affixed cash amounts casino chips. It does not include property that is not exchangeable for a fixed amount. So things like it would appear Bitcoin. If you got tips in Bitcoin, that would not be a qualified tip. It'd be taxable to you, but not a qualified tip. It's property. Tips in property are not part of qualified tips. Gang, they are still taxable. I realize people go down the road and say, well, that means we don't pay tax on them. Do I think a lot of people will fail to report them? Yeah, but again, tax fraud is not something we technically are supposed to, say, go for it, client. That's not it, because you get caught with that, there's no defense. And I don't care that that all your buddies don't do it. Yeah, your buddies aren't staring at the agent right now. Although if you want to give the agent the names and address of your buddies, maybe they could send an agent go talk to them. Yeah, I don't think that's how you want to make it work. The one crucial deal here, though, is the payment must be voluntary. And they make very clear something we've thought since day one: those mandatory service charges, or those automatic 18% gratuities, are required for a party of X, whatever the number is or more. Those aren't qualified tips unless customer can freely disregard it. I'm not paying any of that, right? Or modify the amount. I'm going to pay half of that. If that's truly a required payment, it's not a qualified tip under the law. The law itself defines it as voluntary. So that's been true. The deduction is capped at $25,000 per year, regardless of filing status. For self-employed individuals, the deduction cannot exceed the net income from the business where the tips were earned. So we have that type as well. Income phase out. We talked about this one before: 150,000, 300,000. We talked about Schedule 1A. Now, the specified service trader business restriction is an odd one. Tips received in the course of an SSTB are not qualified tips. Now, let's talk about it in two contexts. Context number one: if you're an employee, then we look at whether your employer is considered a specified service trader business, or would be if 199 Cap A applied to them. If your employer is considered that, then I don't care what your tips are, right? Maybe you decide to, in your CPA firm, hire a barista, who will make coffee and, make coffee for all your guests. And, and they could get tips. The fact they're working for a CPA firm would make those tips not qualified tips for deduction purposes. Okay. But if you are self-employed, then remember, you're now the business. And so now let's take an example. Performing arts are generally considered specified service trader businesses. Well, if you're a self-employed musician, let's say, that you go, you take your guitar and you're self-employed, you're hired by, let's say, restaurants, you do gigs at restaurants, or hotels in the lobby area. You sit there and you provide music and people tip you, right? If you're self-employed, then those tips are not qualified tips because you're in a specified service trader business. However, if the hotel or restaurant employs you, you're still a musician, they're still performing art. But because the business in the specified service trader business, those are qualified tips. Because as we'll discover, musicians are in the list. But they can't be self-employed musicians. It's a weird rule. Now, obviously, to get this, I remind you must have a valid Social Security number. And if you're a married couple, it's got to be a joint return. You can't file separate returns to claim this. Now, we got the kind of official list. The Treasury Tipped Occupations Code, the TCOC, the TTOC. Right? Your IRS developed a list of eligible occupations using tax data, tip program information, legislative history, and survey data. It adopted a more than occasionally standard to define customarily and regularly. Yeah, people in the tax compliance business don't more than occasionally get tips. So it's been that's not a business that would be customary and regular. So nope, they're not in the list, right? The IRS created a new classification systems which is the TTOC, because the standard occupational classification systems, those were simply too broad in their definitions. Didn't really isolate down the way they needed to. Now, the IRS also took a broad interpretation of allowed tip sharing. Who could be in there? It explicitly includes occupations that receive tips primarily through tip sharing or pooling arrangements, even though they have no direct customer interaction. That's dishwashers. That is based on specific language in IRC section 224D3. So even if they're not considered eligible for tip structures in other laws or under other laws, for like setting minimum wage, etc., we're going to define it broadly here because in many cases, those people do share in pooled tips. So they're going to allow that in their list. Now, the 8 key categories, beverage and food service occupations, and under each one of these, we have very specific items listed: entertainment and events, hospitality and guest services, home services, personal appearance and wellness, recreation and instruction, and transportation and delivery. Now, there is a little problem that we have. You'll find this list twice if you download the proposed regs. Once listed in the preamble, called Table A, as I recall, and once in the regs. What's our problem? Well, all the occupations are the same in both lists. All the occupations are listed in both lists. There's none missing. The problem is the assigned TTOC number is inconsistent, right? As I recall, you're going to find that in home services, they're inconsistent. Or personal appearance and wellness was, I forget now which one it was. Oh no, it was number 6. Personal appearance and wellness, they're inconsistent. The problem there is we have what's the last one in the list in the reg is actually put in the middle of the list in the first table. So we have all kinds of numbers off there. And then in personal appearance, like I said, in recreation and instruction, we just have 2 that swap positions, right? They're in exactly a different position depending upon which list you're in. So be careful working from the TTOC numbers there. I would wait and see what goes into the final regs, or at least what goes in the instructions, before I committed to a TCOC number by working off what you see here, because my guess is they will modify the preamble to come in line with the reg. Because if it actually got enacted, the reg would be what would be enacted. So my guess is it'll be easier not to change the reg and just reorder the table in the preamble. But we'll have to wait and see if they do that. I'm not sure they can. Again, as I record this, the thing to be published on the 22nd is out, but obviously hadn't been published yet. I have no idea if the IRS might have caught that early, if they might have known, because I spotted it. The way I spotted it, I'll be totally honest, I throw these developments into Notebook LM, and allow it to start working up the basics of how this, how the discussion is going to go. What's the basic summary of this thing and how it goes. Notebook LM noticed that these numbers didn't agree. It's like, I got 2 sources for this. It sort of pointed out, this one is done this number here, this number there. And I followed it back up, looked in there, and they're there. So be careful with the numbers. Okay. So what are each of these? Food and beverage is wait staff, bartenders, back of house staff like dishwashers and chefs and cooks. Personal services covers a whole wide range of occupations: house painters, pet sitters, nannies, barbers and hairstylists, massage therapists, tattoo artists. Transportations include taxi and rideshare drivers, food delivery drivers, and home movers. Gig economy occupations, rideshare drivers and digital content creators, streamers or influencers. That list is the exclusive source. The breadth of occupations is wider than you might have expected, especially those gig economy. You got to review things and be careful. Now, the other key thing is there is a specific rule there that says it does not apply if your occupation is illegal, right? Nor does it apply, if basically for occupations that involve pornography. Yeah, that last part becomes, remember the old Supreme Court definition, what's pornography? I'll know it when I see it. Yeah, we could see disputes there. We're going to get a better definition than you know it when you see it. I'm not sure. It does appear to be the Supreme Court's definition. We'll take a look. That could cause some problems, has been speculated, especially for some OnlyFans accounts, right? Because while an influencer, an online maybe who's getting tips, be it for their YouTube channel or be it for their OnlyFans, they take tips. Let's say that they're an influencer who is, doing technology reviews, tech has a tech channel or has a channel that's on nutrition, whatever. Those seem fine, right? So, but we'll have to see. So that's a little more interesting. And yes, because there's been speculation. Is this like aimed at OnlyFans? Is that what it's aimed at? So we'll have to be a little bit careful there. And also watch out for the specified service trade or business. That's the other problem you're going to have with some of the influencers. If like you're an influencer and you're publishing like music videos and you're getting tips, again, we're back to SSTB. We have a potential problem there. So yeah, that could be interesting. Well, this has been the current federal tax developments for the week beginning September 22nd, 2025. As always, it's brought to you by your state society of CPAs. If you have any questions, you can email me at Zollars@currentfederaltaxdevelopments.com. I also am a member of a number of state societies, and I tend to hang out on some of their Connect sites. So you can find me. I monitor discussions on the Connect sites for Arizona, New Jersey, Idaho, Illinois, Minnesota, and Washington. So if you're a member of those societies, you can post on some of their boards, and I may see your question. If I have time, I may answer. Otherwise, we plan to be back here next week, see what else comes up after this week's setup, to see what goes on as we head. Remember, we are now heading toward the trust due dates. Your partnerships and S corporations, they weren't filed by the 15th of September in their calendar year, you're probably late. Unless you're in like California and you're still you're in certain parts of California, covered by the LA wildfire things. Then I think you still got till October 15th, as I recall. But yeah, otherwise we're kind of stuck with what we have. So in any event, as I said, we will see you next week here on Current Federal Tax Developments.